All right, in this video, I want to talk about how you can thrive in an uncertain market, the kind of market we're in right now. We don't know what's going to happen. We feel like we're overdue for a recession, but we're not sure. So this is relevant for you if you're an active investor and you're buying stuff right now, or you're raising capital for somebody. You're like, should I wait this out, or what should I be careful of? And if you're a passive investor, you're asking the same question. Should I wait, or if I do invest with someone, what should I be looking for? So Brian Burke owns 3,000 units, 700 houses. He spoke at Dealmaker Live a few weeks ago, and he shared with us his 4 key takeaways from that presentation at Dealmaker Live about how to thrive in an uncertain market. Here we go. All right, the first tip is don't try to time the market, okay? No one is good enough. No one's got a crystal ball. Don't try it. Instead, stay away from cyclical markets. These are a lot of the West Coast and East Coast markets. They have a huge run-up, and then they might have a crash. Instead, go into more stable markets, and these are more in the middle of the country, the Midwest, the Sun Belt. They're not nearly as exciting, but they don't drop as much either. The second thing is you want to follow the growth. Okay, Brian called it ride the big 3: job growth, employment growth, income growth. Okay, so follow those trends, but you also want to follow them in places where there's still yield, cash flow, and potential for appreciation. The great way to analyze these things, there's 3 free reports out there. One of them is the Marcus and Millichap apartment report. They put it out once a year. It's free. You got to put your email address in there. So search for the Marcus and Millichap apartment outlook, I think it's called now. The other one is the IRR viewpoint report. The IRR viewpoint report, just Google that. And the other one is the Milken best performing cities report. If you want to, I actually created a separate video on how to use these reports. It's called the 3 steps for picking the best areas for multifamily deals. All right, so those are the blog posts I want to look for, and now drill down on how to use those reports. So again, key takeaway: follow the growth. Don't try to time the market. All right, here's tip number 3: be conservative in your projections. This is important if you're an active investor, the way you underwrite deals, and if you're a passive investor, look out for the things I'm about to tell you. Okay, so number 1, rent growth. Be conservative in your rent growth. If you're projecting a $150 rent increase in year 1, that's unrealistic. Think about it. That means you're going to have to actually evict people and put new people in there. So that's never going to happen. Okay, so be very conservative with your rent growth. And if you're a passive investor, be very cautious of someone who's projecting giant rent growth in year 1. Over 2 years, absolutely, but year 1, probably not. Be conservative about your vacancy, your economic vacancy, because this includes, make sure you include loss to lease, bad debt, concessions, anything that affects collections at the market level. A lot of people are aggressive on that. Use at least 10%, possibly even more depending if it's a heavy value add deal because of the turn that you have. All right, debt structure. This is also very important. You got to have the appropriate debt on here, meaning that if you're doing a heavy value add deal, don't put 10-year debt on it because you can't finance that out. You have prepayment penalties or defeasance or things of that nature. Okay, on the other hand, if it's a stable value add deal, don't put a short-term bridge on it. That makes no sense. That means you have to refinance out in 2 or 3 years. So make sure the debt is appropriate. Make sure the loan to value is conservative as well. Cap rates at resale. Okay, this is really important. I see a lot of syndicators putting deals out there at cap rates equal to or lower than what they're buying right now. That makes no sense at all. Cap rates are probably not going to go down. They may, but who knows? They're probably going to be staying at, or more likely are going to be higher in 5 years. So the more conservative your cap rates, the better. We always add at least a half a point to wherever the market is right now. If we can do more and the deal still works, it's going to be even better. And then make sure you stress test your projections. If you're an active investor, what worst case scenarios can you dream up, and what will happen to your NOI? What will happen to your debt? What will happen to your break-even point? So stress test your projections. Okay, so, and number 4, never run out of cash. If you're an active investor, make sure that when you close, there's enough money in escrow for emergencies, unforeseens. If you are a passive investor, make sure that your operator does this at closing. Okay, also, you want to take money out of cash flow for reserves. So the rule of thumb is $250 per unit per year. That comes out of the cash flow, that's above the line. It will reduce your NOI. Okay, any operator who does not take that out, a quote above the line, is cheating. Okay, the returns you're seeing are overinflated. So those are my 4 tips, guys. Don't try to time the market. Follow the growth. Be conservative in underwriting, and never run out of cash. Those are the secrets to thriving in today's uncertain market.
All right, I hope you enjoyed that. Now, as the next step, download this ebook right here, okay? When you've downloaded that, make sure you also subscribe to my YouTube channel, because then you can get all of the videos that I release as soon as I release. So make sure you subscribe to the YouTube channel right now. Click on that right now. And then also make sure that this is the next best video to watch, is this one right here. So hope you enjoyed that. I'll catch you next time.